So you probably noticed over the last couple of years that crypto ETFs have been appearing on the market, and they've been attracting billions of dollars in funds. So on the outside, they all kind of appear to do the same thing. They track either Ethereum or Bitcoin. When Bitcoin prices go up, the value of the funds in your Bitcoin ETF should also go up, right? Except that's not always the case. There can actually be a lot of ways that cryptocurrency, commodity, or cash currency ETFs can be different from one another. And one of the biggest differences comes down to the core structure of the ETF, whether it is a physical or futures contract ETF. So in this video, I'm going to look at how those two structures work and why you might choose one over another. And I'll especially be focused on cryptocurrency ETFs because that's super relevant right now, but the same rules can be applied to any type of commodity themed ETF. And because this stuff is really complicated, I'll be talking to industry expert Dan Anand. He is the CEO of Cosmos Asset Management, and they manage multiple crypto funds, and they're responsible for one of Australia's first crypto ETFs. Plus, they are also the awesome sponsor of this video, so if you want to find out more about what they do and their crypto funds, then I've left a link in the description below. And just a quick note, this is not financial advice. If in doubt, please speak to a financial advisor. On to the video. Okay, so 2021 was a really big year for cryptocurrency ETFs. In May, the world's first physical Bitcoin ETF launched on Canada's stock exchange. Then a few months later, the United States got its first pure play crypto ETF. That was the BITO ProShares Bitcoin Strategy ETF. So both ETFs track the price of Bitcoin, but if you check out their performance over the last few months, you'll notice they're not exactly identical. And you'll see the same thing if you compare the performance of, say, two gold ETFs or two oil ETFs. So it begs the question, what are these ETFs doing differently from one another? And why don't they exactly mirror each other? I put this question to Anand, who explained that the difference comes down to how these two ETFs are managed and how they're designed. And more specifically, whether they're using a physical commodity as the underlying asset or whether they're trading derivatives products.
It is extremely important for investors to do their homework and understand the different structures that are available to them. There are three ways you can deliver ETFs. One is full replication. Full replication essentially is taking the underlying asset and delivering that precisely to the underlying holdings. So for example, if we're talking about the S&P 500, full replication would mean you'll go out and you assemble all the 500 stocks by their market cap and deliver that in the ETF structure. The second is optimization. And optimization comes about when there's liquidity constraints regarding the underlying. So an example would be the emerging markets equities market or emerging markets fixed income market. Typically, when it comes to those assets, liquidity within the underlying securities can be constrained. And so from an issuer perspective, what you'd want to do is optimize the basket to deliver the returns of that specific sector or index. And the third is around using derivatives or futures or swaps, for example, to deliver the exposure of the underlying asset. When comparing three products and you have the ability to own a product that gives you physical full replication, that's your optimal choice. Bear in mind the total cost of that exposure. If that's not available to you, then the second option is optimization. And if that's not available to you, then a futures-backed exposure is your only option. Then it's your best option to gain an exposure to that asset class.
So in the case of the crypto ETFs, Canada's purpose Bitcoin ETF is what is called a spot ETF, while the BITO ETF is a synthetic ETF. So in other words, it uses futures contracts to track prices. To break it down further, we'll start by looking at spot or physical ETFs. If you've been watching the crypto market, you probably already know that spot Bitcoin ETFs have been a long time coming, with the first attempt at listing in the United States dating all the way back to 2013. Fast forward almost a decade and we're only just starting to see these Bitcoin ETFs launch onto the stock market, with Australia's first physical crypto ETFs arriving in May of 2022. So spot ETFs are the traditional funds that probably come to mind when thinking about cryptocurrency or commodity ETFs. When you invest in the fund, something physical is actually bought and sold. For instance, in a gold ETF, a lump of gold would be physically purchased if you invested in that ETF. And the reverse happens when you sell out or when funds exit the ETF. That gold is sold. And the same thing occurs with a physical Bitcoin ETF. Physical Bitcoin is actually bought by the fund managers and then sold again once funds leave the ETF. That sounds pretty simple, but we can expect a lot more spot ETFs to begin listing on stock exchanges around the world. So how are you supposed to pick one from another, especially if they're all following a similar strategy? According to Anand, that's a really good question because not all spot ETFs are made equal.
Not all products or ETFs in the market are made equal. Now, specifically speaking to the cryptocurrency ETFs that are available to you in the Australian market, because of custody challenges, all the products in the market will be available to you will be designed as a fund-of-fund structure. Now, the key differentiator for how Cosmos designed crypto ETFs, specifically CBTC and CPET, CBTC giving you exposure to Bitcoin and CPET or CPET giving you exposure to Ethereum, is it's a fund-of-fund structure, but we sought out and partnered with Purpose Investments, who are essentially the pioneers of Bitcoin, or the first physically backed Bitcoin ETF in the world. And so our structure allows you to gain exposure to the Bitcoin price movement or Ethereum price movement by owning the Purpose ETF, which is out and listed on the Toronto Stock Exchange. The reason for our structure is the Purpose Bitcoin ETF and the Purpose Ethereum ETFs, again, the first two Bitcoin and Ethereum products to be available to the market globally, are tried and tested exposures, with Bitcoin being 1.2 billion in market capitalization, Ethereum approximately 500 million in market capitalization, that has daily liquidity to give Australian investors access to the price movements of Bitcoin and Ethereum through the Purpose ETFs listed out in Toronto.
So that's spot ETFs, but then we have the other type of ETF, which is a structured or synthetic ETF, and these are a little bit more complicated. Like I said before, structured ETFs use derivatives contracts to track prices of underlying assets. That underlying asset could be Bitcoin, it could be oil, it could be gold. So when it comes to a futures contract gold ETF, for instance, no gold is physically bought when you invest in that fund. You investing in a gold futures or a gold structured ETF won't move the needle on the supply and demand of gold in the market. And the same goes for a futures contract crypto ETF like BITO. You investing in the BITO ETF won't impact the supply of Bitcoin. It's worth noting that structured ETFs will never exactly match the price performance of the underlying asset. In fact, they can differ quite substantially at times. This is because they don't track the spot price of the asset. Instead, they track futures prices. A futures price is an agreement in a contract for a delivery of an asset, for instance, Bitcoin, at a later date. So it's based on what market players think the future price of the asset will be. So if there's an unexpected market crash or a bull rally, those ETFs could be slow to catch up. Then there's what's known as a contango event, which is complicated but important to understand, because it can result in futures contracts delivering a less profitable outcome than trading physical assets. Essentially, this happens when the futures price of a commodity is higher than the spot price. But don't take it from me, take it from Anand, because he can explain it a lot better than I can.
The futures price essentially gives you a future price of a current asset, and that price is estimated based on what the market sentiment believes what that future price is going to be. Now, in normal markets, futures contracts tend to roll rich or roll in the contango. And what that means is, in normal markets, in an uprising market, as you can see, if I'm pricing a price in the future, then I have to take into account that the current price is going to be lower than the future price, and hence I will price that price higher than the current spot price. When you own an exposure that is backed by a futures contract, you have to keep in mind of this roll cost. The futures contract is always going to underperform the physically settled ETF exposure. Reason being that the futures contract is going to roll rich. What does that mean? The existing contract is going to be at a lower price, And then when you roll the contract into the future price, it's going to be higher relative to the spot price or where that current price of the asset should be.
So just as an example, Horizon's front month rolling futures Bitcoin index is down around 35% at the time of recording, while in the last 12 months, Bitcoin itself is down just around 26%. So essentially, it's underperforming Bitcoin. Okay, next I'm going to look at shorting the market. Although it is a risky strategy, one of the benefits of futures contracts is that you have the ability to profit in both a rising and a falling market. By that same token, of course, it also means you can lose in both scenarios, as always. Only certain types of ETFs allow you to do this. ETFs that increase in value as the market falls are called bear ETFs or inverse ETFs. The idea is that for every percentage the price of a commodity or index falls, the bear ETF will match in returns. Essentially, you're shorting the market. So for instance, if oil prices are crashing, you could move your funds from an oil ETF into a bear oil ETF and continue to profit from the falling market. Of course, the strategy is risky because it relies on you being able to successfully time the market, which is a strategy even the experts get wrong a lot of the time. Okay, so taking all this information in, how do you compare? So Anand explained that at the end of the day, which type of ETF you choose will come down to your personal preferences, your investment goals, and also what you easily have access to. One really important point is to look at the costs. Be sure to check the management fees. These are usually called the MER fees in Australia. Any performance fees, especially for active funds, and also the brokerage fees to invest in the ETF. This is the fee that you pay whichever stockbroker you use to access the ETF. And also, if you're investing in an ETF that is listed overseas, the brokerage fee is probably going to be different than if you're investing in one from the Australian market. Plus, you'll probably be expected to pay a foreign exchange fee. To round this all up, look, it's an exciting time for ETFs, especially with the arrival of these new physical commodity ETFs, which allow everyday people to invest in assets that they wouldn't ordinarily get access to. Cryptocurrency ETFs are undoubtedly among the most anticipated, following almost a decade of proposals and rejections from regulators. And with cryptocurrencies like Bitcoin and Ethereum becoming increasingly mainstream, there's no doubt we can expect some pretty exciting changes to take place in the industry. I wanted to ask Anand what he thought about the future of cryptocurrency ETFs and where he saw the new Cosmos ETF sitting among it all.
The blockchain technology for which the Bitcoin and Ethereum cryptocurrencies are built is going to transform our economies and future businesses to come. And at Cosmos, we are, again, extremely excited and feel proud to be able to deliver access to this asset class for investors.
Thanks for watching the video. If you're interested in learning more about how spot and futures ETFs work, I've left some links in the description below. Plus, I've done a couple of other videos on this topic, so please check them out if you're wanting to delve further. I'm personally pumped for more crypto ETFs to come onto the market, especially a diversified cryptocurrency ETF that will let you invest in multiple cryptocurrencies at one time. But what do you think about it? Are you planning to invest in a cryptocurrency ETF? Why or why not? Please leave your comments in the section below and follow along if you'd like to see more content like this. Bye guys.